Hello traders, and welcome back to another video of Nova Forex. A lot of day traders are struggling with finding the end of the pullback during the trending market. Finding the end of the pullback helps the traders in getting the sniper entries, which leads to earning higher profits from the market. If you are also facing this issue, then don't worry, this video would help you in resolving this issue. Before commencing the video, if you think this video is informative, like it and subscribe to the channel along with hitting this bell icon to never miss out any of the upcoming videos. In this video, we will reveal a highly effective Fibonacci trading strategy that will allow you to determine the end of the pullback. Let us commence the video now. Before learning the strategy, we'll explain you some of the basics related to this topic so that you can understand it properly. The market moves into the two phases, which are trending phase and ranging phase. During the trending phase, the market is either in an uptrend or in a downtrend. And during the ranging phase, the price is in the consolidation phase. Trading into the market during the ranging phase can be unsafe, as the market might go in the opposite direction also. And thus, most of the traders trade mostly into the market when it is in the trending phase. But there is a problem into the trending phase of the market also. During the trending phase, they cannot enter at any point into the market. Like during an uptrend phase, when the price is moving to the upside, a lot of traders begin going long into the market when they witness these big green imbalance candles forming into the market. When the market makes a pullback, traders face significant losses as their stop loss gets hit. To avoid losing money, we suggest only going long or short in the market when there is a pullback occurred. The price into the market never moves into the straight line, even into the trending phase. We see a series of impulsive moves and pullbacks during the trending phase. Like in this case, the market is in a clear uptrend as the price has made the break of structure to the upside. But although the market is in an uptrend, why these pullbacks are occurring into the market? The pullbacks are occurred into the market due to short-term traders. Like here, the market first made an impulsive move, and then, the short-term traders who had previously gone long into the market would sell the currency pairs into the market, which would lead to increase in the sellers of the market. And the increase in sellers of the market lead to this pullback. And the second reason for the pullback is that the sellers are considering going short in the market as they believe that the price has become expensive at this point. The price pullbacks occur many a times into the market because it is inevitable that price is cycling and pulling back and forth all the time. Through the pullback, the traders can easily buy the stock at a low price and sell it at a higher price during an uptrend, and vice versa in a downtrend. But in order to get a sniper entry into the market, we need to know the point where the pullback would end. And here is where the Fibonacci retracement levels would help us. The Fibonacci retracement tool helps us in predicting the exact area of the end of the pullback through its levels. Like in the trending bullish market, we would mark the Fibonacci tool from recent low of the range to this recent high. The Fibonacci levels, which are highly respected by the market, are 38.2%, 50%, 61.8%, and 78.6%. The Fibonacci tool also helps us in identifying the premium and discount zones. Like in this example, the price is in a premium zone currently as it is above the 50% fib level. Similarly, the market is said to be in a discount zone when it goes below this 50% fib level. A lot of traders wait for the market to come into this discount zone in order to go long into the market. But every time, the price would not come at the discount zone. Sometimes it may reverse from the premium zone also. This is because if there are aggressive buyers into the market, then there are higher chances of market getting reversed from this premium zone only. That is because there are a lot of buyers who are ready to buy the currency pair at this premium zone. And that's why we recommend you to don't wait for the price to reach at the discount zone for initiating long or short trades into the market. If the market is making rejection candles at the 50% fib level or above it, then you should wait for the market to give out a confirmation, and then you should go long. This is because it could be a trap also to gather the counter orders. And which is why confirmation is crucial in such type of situations. If the market makes some bullish candles with bodies bigger than its wicks, then we think of going long into the market. But the market would not always make a pullback. Sometimes it would continue going into the opposite direction also. Like in this example, the market was in an uptrend, and then the market started to make pullbacks. Now the traders would plot the Fibonacci retracement tool from this range's low to this range's high. And then, once it makes rejection candles followed by the bullish candles, they would go long into the market. Let us see how the market reacts when it reaches at this fib levels. The market is making rejection candles at this 38.2% fib level. Now this is where the impatient retail traders loses their capital. This is because they would go long once they see this rejection candles, and also, previously this level was respected by the market. But instead of going long from this point, they should wait for the market to show some bullishness which confirms that this pullback has ended and the market would continue its trend further. Here we can see that the market first made some rejection candles, but then it went below this level and continued going below this range low, which removed all the buyers from the market. And this is why confirmation is so necessary when initiating long or short orders in the market. Now let us learn about the strategy of the Fibonacci levels. So, in this strategy we would mark the key levels first, and then once the market makes the pullbacks, this key level would help us in knowing that from which fib level should we go long or short into the market. The smart money relies on key levels to set their buy or sell limit orders, which is why utilizing them could result in significant profits for us. And that is why we would first mark the key levels on the higher time frame, as the market respects the key levels more of the higher time frame. Now let us move on into the strategy. The first step in our strategy is to mark the key levels into the higher time frame during the trending market. Before we begin explaining the strategy, let me tell you this thing, that this strategy only works during the trending phase and not during the ranging phase of the market. In order to understand this strategy properly, let us learn it through an example. The first step in our strategy is to go into the higher time frame and mark the key levels like supply and demand zones and support and resistance zones. So, here we have the gold chart on the 4-hour time frame. The market is currently in an uptrend as it is doing the break of structure to the upside. The market is making series of impulsive moves and correction moves. Our objective is to enter the market during correction moves, which will help us earn nice profits. The market made an impulsive move to the upside, and then it has started to make the correction move. A lot of traders would go long once they see this correction. But we would not do so, and instead of that, we would find the exact area at which this correction move would end. For knowing the end of this move, we would use the Fibonacci Retracement tool. The Fibonacci Retracement tool provides us with the important levels from which the market may end its corrective move and continues its ongoing trend. Now there is a problem with the Fibonacci Retracement tool also. The problem with this is that this tool has provided us with this 4 levels. But at which of these levels should we enter to increase our profits into the market? That's the problem. Now at this situation, the key levels would help us. We would go to the higher time frame, which is the daily time frame in this case, for plotting out the key levels. So, at the daily time frame, the market is seen getting rejection at this zone multiple times, and thus, we can conclude that this is a resistance zone. And then, while making this impulsive move, the market broke this resistance zone and went above it, which attracted buyers. This key level is near the 78.6% level, and which is why we would take entry near this level. We would again switch over to the lower time frame for confirmation and entry. The market is making rejection candles at this 78.6% level. And thus, we would initiate our long trade into the market from this level. We would place our stop loss below this key level and place our targets at 3 times the stop loss. The market went above, which helped us in earning significant profits. So, in this video we shared the best Fibonacci retracement strategy that could help you in earning significant profits from the market. But we recommend you to backtest this strategy before using it out in your trading. This is where our video ends. But before we do so, if you found our video useful, then like the video and don't forget to subscribe the channel and hit this bell icon so that you don't miss out any of our upcoming videos.